speculators have shifted from greedy to distinctly scared as the innovation complex undergoes multiple compression. RK tumbled 4.71%, while SPHB fell nearly 4%, signalling rapid capital rotation out of speculative tech positions. The Parabolic 7 trade, once a favourite among retail investors chasing AI momentum, is unwinding across Micron, SanDisk, and Marvell as valuation corrections accelerate. XLY, consumer discretionary, and XBI biotech also retreated around 1%, suggesting fear is spreading beyond pure semiconductor names into broader growth exposure. This mirrors how the market behaved before 2022's tech bear market. Speculation peaks just as fundamentals begin to diverge from headlines. Credit remains stable with high 0.55, HYG 0.28, and HYGW 0.28, all edging lower in tandem, suggesting no stress is building in the high-yield market. The synchronized decline mirrors broader equity weakness rather than selective credit concerns. Yields are implicitly rising as prices fall, but not at a rate that signals corporate distress, more like portfolio rebalancing. This stability indicates banks and investors still view credit markets as functional. The worry today centers on equities, not balance sheets. Fear is actively rising as all three volatility proxies move higher. UVXY plus 225%, VIX plus 126, and VXX plus 135%. This isn't passive hedging, it's active positioning against a downside that could deepen if the Parabolic 7 unwind spreads to other overextended tech names. The headline risk is no longer geopolitical but rather earnings-based. Investors are pricing in mean reversion after months of AI-driven optimism. VIX at 1639, up +6. 42 male sits above its recent range, suggesting traders expect increased intraday turbulence ahead of Friday's close. Following the May jobs report backdrop that left futures mixed pre-bell, the real economy shows a fractured signal. SMH semiconductors crashed 4.09% while industrials gained +157%. This divergence suggests cyclical demand for equipment and infrastructure is holding, even as discretionary chip spending cools from AI hype cycles. KRE, regional banks, edged up +0.73%, indicating credit conditions remain stable despite the broader risk-off tone. IWM, small caps, fell 1.54%, trailing Nasdaq's 2.23% but leading Dow's negligible 0.35%. The industrial outperformance versus semiconductor weakness could signal manufacturing orders are more resilient than tech capex projections, though earnings disappointments in chips, like AVGO, may be dragging the sector lower. Safety is showing selective rotation rather than broad flight to safety dynamics. GLD dropped 2.43% alongside equities, which is atypical. Gold usually holds or gains when stocks fall, unless it's a coordinated sell-off in alternative stores of value. TLT barely moved 0.42 miles, while XLP, consumer staples, gained +1.63%, indicating defensive positioning within the equity complex, rather than a true risk transfer to hard assets. The gold decline could reflect profit-taking on recent strength or rotation into FX-hedged positions given the dollar's modest 0.4% gain. This suggests investors are repositioning defensively, but not abandoning growth entirely. A nuanced stance between fear and conviction. The market is executing a classic post-hype correction. Speculative tech names are shedding valuation premiums while defensive staples hold their ground. The real economy isn't breaking. Industrials and regional banks show resilience, but investor confidence in AI-driven growth narratives has cooled sharply. Fear is rising, but not yet at panic levels. The question is whether this unwind continues into Friday, or if it's a healthy reset after months of parabolic moves. Watch tomorrow for whether semiconductors stabilize below their recent lows. If SMH breaks further, expect broader tech to follow suit, and spec leaders like ARKK, FASH, SPHB could extend losses into double digits.